Geeta Gopinath, who's used to be the chief economist over at the IMF, tweeted just a couple hours ago, look, the difference is this. The difference is between having cholesterol, high cholesterol, and having a heart attack. And she's saying, look, a balance of payments crisis, if we had that would be a heart attack. What we've got now is just high cholesterol. So in other words, even though using 122 is legal, nobody's saying it's not, it doesn't meet the conditions. It doesn't meet that bar. What do you think?
I thought that was a great analogy. That makes me laugh. Dead on. Well, Martin, do you think that really matters? At the end of the day, I mean, yeah, it may 122 of the Trade Act of 1974 stipulates the balance of payments as the criteria that there's got to be a crisis there, and there's obviously not. But it doesn't really matter because the president can invoke it, and of course there will be lawsuits and challenges and goes through the process, and we'll be back here a year from now. The Supreme Court may rule on that, say that's illegal. But, then we're off to something else. So, at the end of the day, I think the president can pretty much get what he wants on the tariffs, right? I mean, he can gerrymander whatever laws there are out there, work on the sectoral tariffs, because that he legally, there's no argument there. He can impose those. So, if he wants 10%, he's going to get 10%. If he wants 15%, he's going to get 15%. It's just, the question is, how does he get there? Is it legal or not legal? I don't know that really matters.
Yeah, and a whole bunch of numbers to go through, 122 and later probably 232 and 301 and even 338. But anyway, listen, Mark, you've been out publicly saying the last couple of days, right now the U.S. economy is looking fragile. The president's going to be trying to talk up in his first year, right, what he's done positively for the economy. That's pretty obvious. I think we can expect that. But this is an economy where if there is growth, it's come with little to no hiring, and that's sort of the weird part, right? And the last couple of days we've been talking about, I don't know whether you've seen this or not, the Citrini report, which came out, I think, several days ago, talking about, look, this is the future, potentially. I mean, it's fiction, right? It's sci-fi, but this is the future that we could have with AI. Is that going to be factoring into the president's thinking at all, or does he not think about AI, do you think? I mean, is that going to get a mention in the speech?
I don't know. That's a good question. I mean, if he does talk about it, I'm sure he's going to talk about AI as a friend, not as a foe. But you make a great point. I did read the Citrini piece. It was, very well written and very engaging and thoughtful. And of course, but at the end of the day, it's a story. So, who knows? But, what I do know is that the economy is not creating any jobs on net. And it hasn't really since Liberation Day back last April when the reciprocal tariffs were first put on. Since then, the economy, some months up a little bit, create some jobs, some months down, some months net, we've gone nowhere. And I don't expect that to change. And that's in a world where AI has not really played much of a role, at least not in terms of productivity gains. I don't think there's been any real impact there, at least so far. But that's going to change, Citrini or not. Directionally, we are going to get productivity gains from AI. You can feel it, you can see it, just listening to what the CEOs are saying, about how they're going to use it. And what does that mean in a world with no job growth? So if we're in a world of no job growth and we get these productivity gains, doesn't that mean job loss? And how does the economy digest that? I don't know how that goes to the point I'm trying to make about fragility. It feels just very fragile to me, particularly in that context. So I don't think that's not what the president's going to be saying, and I don't think he's going to be focused on that. But I think that's the reality of the situation.
No, fair enough. Okay, you think, I mean, a lot of the elements are in place for a meaningful sell-off, right? Highest threat probably over stocks, also corporate bonds. This is the interesting part, though. You're thinking that crypto, gold, and silver are still at risk. With crypto, we've seen that. We've got Bitcoin at, below 65,000 right now. Gold and silver, why would they be at risk? I mean, especially if, the timing of this is, let's say, right, we do have a second military strike on Iran. I mean, I would expect gold and silver to continue rocketing.
Yeah, okay. So you're reading my X post. Thank you for doing that, Martin. But this goes to another aspect of the fragility that I'm talking about, and this is in the financial markets writ large. Mostly stocks and corporate bonds. There has been a correction, as you point out, in Bitcoin, and we've seen some sell-off in the gold and silver markets. But I think broadly speaking, even in those markets, there's still elements of speculation that investors have been buying simply based on the fact that those prices were rising in the past, that they will rise in the future, or they're thinking it's a good, potential, safe haven, if something does go wrong, like an invasion, like a military action in Iran. But, all the asset markets, to one degree or another, mostly stocks and corporate bonds, feel overdone to me, feel overvalued, feel frothy, feel somewhat speculative. And when you're in that kind of speculative environment, if anything doesn't stick to script, and you can just feel it, like in the action in the stock market the last couple of days, a research report from Citrini comes out and it causes the stock market, the Dow, to fall 850 points. That's indicative of a market that's really on the edge. It's teetering because of the speculative aspects of what's going on, and that's what I'm concerned about. So that's the preconditions for a much more significant sell-off in markets going forward. But you're right. We've got to I don't want to paint with a broad brush. Each of these markets has its own idiosyncratic thing going on. They'll be affected by different factors and forces, and so we got to take it one at a time. But broadly speaking, feels like financial markets have gotten ahead of themselves. Just another vulnerability, another reason why I characterize the U.S. economy as being fragile.